Welcome to This Explainer. Today, we are diving straight into the biggest investing mistakes that are keeping millions of people stuck in a financial rut. And more importantly, we're going to reveal the exact, quiet strategies that wealthy investors use to build absolute fortunes over time. We're going to strip away all that complicated financial jargon and look at the surprisingly boring, yet highly effective habits of the truly wealthy. Let's get into it. Picture this. You've got two friends starting their careers. On the exact same day, they both decide to invest the exact same amount of money. Fast forward 20 years. Friend 1 is kicking back, preparing for a super comfortable retirement with millions in the bank. Meanwhile, Friend 2 is stressed out, realizing their savings are barely keeping up with inflation. So, what exactly was the difference here? Well, spoiler alert, it wasn't a winning lottery ticket. It wasn't about raw intelligence, and it definitely wasn't because one of them had a drastically higher salary. The real difference simply came down to a few quiet, seemingly minor decisions they didn't even realize they were making at the time. All right, let's jump right into part 1, the wealth mindset shift. You know, a lot of people just assume that building wealth requires a towering salary. But honestly, it doesn't. There are high-earning doctors out there living paycheck to paycheck and ordinary teachers who quietly become millionaires. Why? Because the amateur habit is to spend your income first and save whatever happens to be left over. The wealthy habit completely flips the script. They invest first and spend what remains. Your income only creates the opportunity, but this simple behavioral flip, that's what actually builds the wealth.
Moving on to part 2, the absolute magic that is the power of compound interest.
This right here is the mechanical engine driving all long-term wealth. In fact, it's Warren Buffett's absolute favorite rule of money. You've probably heard that famous quote often attributed to Albert Einstein, calling compound interest the eighth wonder of the world. Whether Einstein actually said it or not, the math proves it is hands down the most powerful force in finance. Let's put this into perspective with some real numbers. Say you set aside just $300 a month. Nothing crazy, right? If that money grows at a historical market average of around 10% a year, after 30 years, the total cash you actually contributed out of your own pocket is just $108,000. But here's where it gets mind-blowing. Your portfolio would actually be sitting at over $600,000. So, where on earth did that extra $500,000 come from? That is the beauty of compounding. Your initial money earns a return, and then those returns start earning their own returns. It creates this massive snowball effect that just grows larger and faster every single decade. And that brings us to a massive truth. Time is your absolute biggest advantage. Because of this compounding snowball effect, a 20-year-old who starts investing early can easily outpace a 35-year-old who starts later, even if that 35-year-old is trying to catch up by investing twice as much money every single month. Basically, the earlier you plant the seed, the less heavy lifting you have to do later on. Okay, part 3, the 3 costly investing mistakes we all need to avoid. Mistake number 1, the classic get-rich-quick trap. We're talking the temptation to chase meme stocks, the latest crypto hype, or that guaranteed hot tip from a guy at the gym. History shows us this almost always ends the exact same way. People buy in at the absolute peak of the hype and then panic sell everything when the inevitable crash wipes them out. Then there's mistake number 2, trying to perfectly time the market, guessing the exact tops and bottoms. Let's be real for a second. If massive hedge funds equipped with supercomputers can't consistently pull this off, neither can financial influencers on social media. Successful investors don't guess, they just stay invested. Missing out on just a handful of the market's best days over a decade can effectively slice your long-term returns right in half. And mistake number 3 gets right to the core of human nature, letting emotions take the wheel. Markets go up and down. That's totally normal. It's a feature, not a bug. But fear drives amateurs to sell during temporary crashes, and greed pushes them to buy into wildly inflated bubbles. The wealthy operate completely differently. When the masses panic, they just stay calm, knowing full well that volatility is just the toll you pay on the road to wealth. All right, let's look at section 4, keeping it simple with index funds. So if the pros aren't chasing the hype or trying to time the market, what are they actually buying? Well, instead of trying to find the one winning needle in the haystack, they just buy the entire haystack. They use what are called index funds. An index fund is just a single, super simple investment that owns small pieces of hundreds or even thousands of companies all at once. If one company goes bankrupt, it barely even registers because the hundreds of others carry the weight and continue to grow.
The big takeaway here? Simple almost always beats complicated. It completely removes the guesswork, the emotional stress, and the urge to constantly check your portfolio. Heck, even Warren Buffett has explicitly said that when he passes away, the vast majority of his inheritance should be put into a simple, low-cost index fund rather than trying to pick individual stocks. Which leads us to part 5, the actual habits of wealthy investors. When you think of a millionaire, you probably picture flashy cars and private jets, right? Well, forget all that. True fortunes are built on behavior that is actually surprisingly boring. They automate their investments, so their wealth just builds quietly in the background. They avoid bad debt like the plague. They strictly live below their means. They're always learning, and they stay incredibly patient. Building real wealth isn't some high-stakes action movie. It's a quiet, repetitive cycle. You invest, you wait, you repeat. That's the secret sauce. Now, looking ahead into the next few years, we've got this really fascinating dynamic unfolding. On one side, we have rapidly evolving artificial intelligence and fast algorithms executing trades in mere milliseconds. The technology is changing at lightning speed. But on the other side, unchanging human psychology. The tech changes, absolutely, but our human susceptibility to fear, greed, and impatience, that doesn't change a bit. The winners of the next 2 decades won't necessarily be the folks with the smartest AI, but rather those who can maintain ironclad discipline.
You know that old saying about planting a tree? The best time was 20 years ago, but the second best time is today. Well, the exact same logic applies to your money. You don't need to be rich to start, but you absolutely must start if you ever want to be wealthy. Your future self is heavily depending on the quiet, simple decisions you make today. To wrap up this explainer, I want to leave you with one final, totally crucial question to chew on for your own financial journey. If someone handed you $10,000 right now, would you spend it, save it, or invest it? Think carefully about your answer. Thanks so much for joining me today, and keep learning.